This is our financial system.
No one's seen anything like this.
At the end of an extraordinary week.
This is a pivotal moment for America's economy.
In announcing an historic bailout for America's banks, President Bush admitted the financial system is in crisis.
Crisis after crisis.
The health crisis has provoked a financial crisis. Wall Street ended the trading week with another steep sell-off on Friday. At the close, the Dow lost more than 900 points. The S&P 500 and NASDAQ also fell sharply. That helped make last week the worst in U.S. markets since 2008.
And yet, the system keeps inventing new ways to gamble.
Since then, Forbes has named you one of the top 50 most influential people in the NFT space. So congrats on that. You know what you're doing.
Thank you. I'm so proud. I love being a part of this community and being a voice and sharing my platform.
Bitcoin has now round-tripped all the way back to where it was the day before Donald Trump was reelected, even after the crypto industry got virtually everything that it asked for, not just from Washington, but from Wall Street as well.
This global economy is subject to more violent and more frequent shocks.
Something about this system feels increasingly chaotic, and yet the financial system seems to be growing larger and larger. And recently, I even started noticing the same thing in everyday conversations. Last week, I met up with one of my mates, as you do. He told me about how he had invested in gold and how awesome it was because it just keeps going up. Obviously, my first reaction to that was disappointment. Why hadn't I had this grand idea of investing into gold and was getting rich now? Anyway, later that same week, another friend asked me if I'd heard about the prediction market frenzy in the US. Apparently, prediction markets, platforms like Polymarket or Kalshi, are basically online marketplaces where people are literally betting on everything. From elections to Super Bowl scores, whether Jeffrey Epstein is actually dead, and it even lets you bet on the return of Jesus. What the actual fuck? So, after processing that speculative finance had now expanded into theology, and briefly fighting the urge of betting on Sam Bankman-Fried getting released from custody in 2026, I had somewhat gotten over the personal tragedy of not having invested into gold. Not because I somehow transcended material desire. It was mainly because another thought had popped into my head, that everything feels like a casino. And according to quite a lot of academics, this feeling is actually a reality. There's lots of research papers on the casinoification of our global economy. And basically, all of this scientific literature about the so-called financialization of the economy has one fundamental undertone, that since the early 1970s, capital has been allowed to move freely across borders and currencies float. Which made the finance sector explode. This led our economy to sort of turn into an asset economy. And this matters because in an asset economy, wealth increasingly comes from owning assets rather than working. And people who don't own assets fall further behind, while those who already own them get richer and richer. This is the reason why many millennials or Gen Z can't afford to buy their own homes. But to understand the relationship between all of this, we need to understand what the asset economy is and how it came to all of this. So, what actually is the asset economy? The word asset economy represents the shift from industrial capitalism, where profits were made through production, to a form of financial capitalism focused on extracting rent and capital gains from existing assets. Okay, but let's dial it back even further, because what the hell even are assets and what is a financial asset? To put it into the simplest possible terms, financial assets are legal claims on future income and are basically intangible contracts whose value is derived from a legal agreement. There are many kinds of financial assets, like equities, aka stocks, bonds, pensions, mutual funds, insurance contracts, patents, or intellectual property. When you own a stock, you own a claim on a company's future profits. For bonds, you're lending money to a government or a company, and your asset is a claim on the future tax revenue or future earnings. For pensions, you're holding a claim on future contributions and market returns that are supposed to fund your retirement. And once wealth comes from owning claims on future income, the most profitable move is to transform real-world goods and services into income-generating financial assets. And that is exactly what happened. Academics call this process financialization. The process of financialization has led to real-world goods and services such as housing, care homes, transport systems, and labour being transformed into tradable financial assets designed to extract capital gains for their owners. And the weird thing about the rise of financialization, or how some academics like and Pettiful call it, the finance casino, is that the size of financial assets has ballooned completely out of proportion compared to the size of real assets. In late 2023, global GDP, which represents real economic income, was about $100 to $110 trillion. This real economic income represents the value generated by real economic activity, which includes the exchange of goods and services in production and consumption across the world. And yes, I know the measurement of GDP has a lot of flaws, but for this rough approximation, it will have to do. So global GDP, real economic income, is about 100 to 110 trillion. But these $100 trillion in real economic income are dwarfed by the size of global financial assets, which amounted to 486 trillion by late 2023. Okay, but let's take another step back. How and when did this process of financialization even happen? How did we move from an industrial economy to an asset economy? There is an absurd amount of economic literature on how this happened. So what I did is I basically locked myself in my room with all the books, academic papers, and macroeconomic history literature I could find on the topic for weeks, and tried my best to understand how this whole transformation actually unfolded. And at its core, the shift can be understood through 4 structural developments. The first pillar was the collapse of the Bretton Woods system in 1971, when Nixon ended the dollar's convertibility to gold, which resulted in floating exchange rates. The second pillar was ideological, the rise of neoliberal economics. Particularly, the Chicago School of Economics promoted deregulation, the removal of capital controls, and the treatment of money, land, and labor as commodities. This reshaped policies across the major Western economies in the 1980s. The third pillar was the privatization of pensions, which moved retirement from guaranteed public systems to individual investment accounts tied to the ups and downs of financial markets and overseen by global asset management firms. Firms that have become incredibly powerful. And the fourth pillar was systemic legal deregulation. From the repeal of the Glass-Steagall Act to the 2000 Commodities Futures Modernization Act, which removed oversight from derivatives trading and allowed food, energy, and mortgages to be fully financialized. Now, I can't go into every detail of these pillars in this video because that would just take way too long and you'd probably get really annoyed by me rambling on and on and on and click off this video. Also, I've made other videos explaining a lot of the points I just made here in more detail, and I don't want to bore you by repeating myself over and over. But if you haven't heard me talk about these points yet, I talk about the Bretton Woods system and the Nixon shock in this video. If you want to learn more about the rise of neoliberal economics, especially about the Chicago School, watch this video. And if you want to get better at understanding how food, energy, and mortgages were financialized and turned into derivatives, what derivatives are and how they work, I go into all of that in this video. I'm also linking all of the videos in the description of this video, so you can just go down there and you can just go watch them after finishing this video. Because in this video, I'll focus on how the privatization of pensions led to asset management firms like BlackRock, Vanguard and State Street becoming scary powerful, and what this means for our economy. You might have heard of BlackRock before, but for the amount of power they hold over the economy, it is honestly intriguing how little people know about them. And I know pensions don't sound super interesting, but if we want to understand how the global economy turned into a casino and why these asset managers now shape our economy, this is where their story begins. Before the 1980s, pensions were largely defined benefit systems in many countries. Defined benefit systems, I'm going to say DB pensions from now, were state-run plans that provided retirees with a guaranteed set amount of money using tax funds collected from the whole community. Today, that is not the case anymore. Why, you might ask? From the late 1970s onward, corporate-funded academics from the Chicago School of Economics argued that retirement provision should be shifted from the state to the market. Public, collectively guaranteed pensions were reframed as inefficient and unsustainable, and financial markets were presented as a superior, more efficient allocator of retirement savings. And our favourite neoliberal heads of state, Maggie Thatcher in the UK and Ronald Reagan in the US, embraced this model enthusiastically. While state pensions provided collectively guaranteed benefits, the new privatised schemes shifted all financial risk and reward away from the state and onto the individual pensioner. This happened by gifting the finance sector with the world's pension money. Obviously, the pensions were not gifted to the finance sector, but they were handed over for management, which meant funneling trillions of dollars into the hands of global asset managers like BlackRock, State Street and Vanguard, for them to then manage these assets. But what does it mean to manage all these pensions? It means the asset managers take the contributions flowing in every month from millions of workers and invest them across global financial markets: stocks, bonds, derivatives, property, infrastructure. In return, they collect management fees, usually calculated as a small percentage of the total assets under management. So their revenue grows with the size of the pool, not necessarily with its performance, which means they do not bear the risk. If markets go up, pension balances rise. If markets crash, pension balances fall. The asset manager still collects fees. This now basically means your pension depends on how financial markets perform, and the asset manager collects fees regardless. So the asset manager can basically not go broke, even if financial markets crash. Unlike a traditional bank whose balance sheet is threatened when assets collapse, asset managers are simply agents. The losses are absorbed by the pensioner. And because economists don't like speaking plain English, they say asset managers are largely insolvency remote. And also, it is worth mentioning that the finance sector wasn't just handed the pension money for management. While the privatization of pensions provided a massive wall of money for asset managers, they were handed far more than just retirement savings. In addition to pensions, asset managers also manage this money. Trillions of dollars in general household savings and life insurance premiums have been funneled into these firms. Large corporations that sit on vast amounts of cash reserves often hand those profits over to asset managers to invest in financial markets, rather than putting them into productive internal investment. Also, sovereign wealth funds, the savings and profits of entire nations, such as those from oil exporting countries, are often managed by these private Wall Street titans, basic infrastructure and real estate. asset managers have moved into owning foundational physical assets, including schools, bridges, wind farms, and thousands of single-family homes, from which they extract regular rent and fees. Mutual funds and ETFs. These asset managers manage various pooled investment vehicles, including index tracking exchange traded funds, ETFs, which now oversee about a fifth of all shares in the S&P 500. Asset managers even manage central bank assets. For example, the US Federal Reserve gave BlackRock the responsibility of managing the massive corporate debt it purchased as part of its bailout programs during the 2008 crisis. But let's go back and have another look at the numbers. By 2014, private asset managers controlled $87 trillion. By 2023, just 9 years later, that number rose to $112 trillion, which is more than the global income if we look back at the GDP number. So basically, a fifth of all financial assets in the world are controlled by the major asset managers. More money sits in asset managers' financial portfolios than the world produces in a year. Today, just BlackRock alone manages $14 trillion US. What the hell? I'm subscribed to Bloomberg. Luckily, this video is sponsored by NordVPN, so things like this are a problem of the past. I love NordVPN and have been using them for a while. If you are the blessed owner of a NordVPN subscription, all you have to do is open the NordVPN app, click connect, and your internet traffic is encrypted and routed through one of NordVPN's secure servers. That way you can access your subscriptions from anywhere in the world. There we go. Now, the main reason I personally use NordVPN isn't just for things like this. It's also because it protects your internet traffic and keeps your data private online. If you're working on public Wi-Fi in cafes, airports, or hotels, your data can actually be exposed to what's called a man-in-the-middle attack, where someone intercepts your connection, and these criminals will harvest any sensitive data you enter into unencrypted websites. I've become a huge fan of NordVPN's feature called Threat Protection Pro, which can block malicious websites, phishing attempts, and malware before they even load. If you want to try it yourself, you can get an exclusive NordVPN deal plus 4 extra months by going to my link nordvpn.com/AnnaBocker or by just clicking the link in the description. It's completely risk-free with Nord's 30-day money-back guarantee. Thanks again to NordVPN for sponsoring this video. And now that we've unlocked the Bloomberg article with the help of NordVPN, we can go back to discussing how much money asset managers like BlackRock have under their control. And it's important to say, asset managers are not the only players in the system. Alongside them operate hedge funds, private equity firms, and other non-bank financial institutions. Together, they form what regulators and academics call the shadow banking system, a vast network of financial actors that operate outside traditional deposit-taking banks. But the shadow banking system is a topic for another video, so make sure to subscribe if you want to know more about that. Most importantly, we need to remember that asset managers control trillions of dollars in pensions, household savings, corporate money, infrastructure, and real estate, mutual funds and ETFs, and even central bank assets. Now, if you've ever asked yourself why governments always leap to the rescue when the finance sector is in crisis, be it from the 2008 financial crisis to the cash infusion during the COVID-19 pandemic, well, it's because they have to. Why do governments care so much about the finance sector? Because finance isn't separate from the real economy anymore. Grace Blakely even describes BlackRock as a fourth branch of government due to its deep ties with political and financial institutions in her book Vulture Capitalism. But why is that? Well, pensions sit in financial markets, household savings sit in financial markets, corporate funds sit in financial markets, the savings and profits of entire nations sit in financial markets. banks rely on financial markets, and government themselves borrow money from financial markets by selling bonds to investors, which gives the investors, aka the asset managers or hedge funds, a crazy amount of power, because if investors lose confidence in a government and dump all their bonds by selling them in large quantities, the government has to offer higher interest rates to attract buyers, which makes their borrowing more expensive and effectively gives financial markets enormous leverage over public policy. Anne Pettifor writes in her book, whereas in the past interest rates and exchange rates were managed by central bankers accountable to parliaments and governments, today market rates are set by actors in global financial markets. Finance ministers live in fear of markets that may disapprove of government spending plans. Private speculative markets that, as punishment, will hike the prices, yields, on government bond sales while downgrading the value of a nation's currency by selling it in exchange for another. So this is why governments care so much about the finance sector. First, because financial markets now hold enormous power over governments. They influence how expensive it is for governments to borrow. They can drive up interest rates, they can weaken a currency, they can effectively discipline public policy. But second, and just as importantly, governments care about financial markets because the entire economy and everyone's well-being is now tethered to those markets. Pensions sit there, household savings sit there, corporate funds sit there, government debt sits there. The entire population is now exposed to these financial markets. So when financial markets wobble or panic, governments rush in, not because they want to protect the speculators of the finance sector, but because if those financial markets collapse, retirement savings shrink, banks freeze, borrowing costs spike, and the shock spreads into the real economy almost immediately. And as we saw in the 2008 financial crisis, millions of people lost their homes, their jobs, and their savings. So back to a question from the very beginning. What is the asset economy? Well, this is the asset economy. In the asset economy, financial markets are not a sideshow. They are the core infrastructure. And once financial markets know they will be rescued no matter what, their behavior changes. Investor risk-taking increases, and risk becomes asymmetric. Investors keep the upside, society absorbs the downside. And we've seen this repeatedly. In 2008, banks and other institutions like AIG were rescued by the US American government because their collapse would have cascaded through the financial system. I go into the mechanics of that in my derivatives video, so if you want to hear more about that, make sure to watch that video. In 2020, central banks once again flooded markets with liquidity to prevent the collapse of financial markets. And when central banks flooded markets with liquidity, asset prices surged, disproportionately benefiting those who already held stocks, property, and other financial assets, which is why billionaires experienced a massive increase in their wealth during the COVID-19 pandemic. Between March 2020 and 2022, billionaires' fortunes increased more than they had in the previous 14 years combined. While most people faced economic uncertainty during that time and global poverty rates rose for the first time in over 2 decades. Okay, so far we've talked about financial markets and governments, but financialization didn't just reshape states and the economy. It reshaped the corporations and workplaces within them, and with that, the lives of people who work for them. Because once asset prices became central to wealth accumulation, corporate strategy began to revolve around protecting and inflating those prices. From the 1980s onwards, corporations were increasingly told that their primary duty was to maximize shareholder value. The neoliberal economist Milton Friedman famously argued that the only social responsibility of a corporation is to increase profits for its shareholders. And in the decades that followed, the economy became obsessed with shareholder value, and that changed how companies behaved. Instead of focusing on long-term investment, many firms began prioritizing financial returns to shareholders, which in practice meant things like cost-cutting instead of long-term innovation, debt loading instead of reinvestment, outsourcing instead of stable employment, stock buybacks instead of wage growth. But let's look at what this means in different industries. In the food industry, cost-cutting didn't just change how food is produced. It changed what food actually is. And I say food here for lack of a better word, because what modern food corporations are selling can barely be called food anymore. Chris von Tolkien quotes in his book Ultra-Processed People the scientist Fernando Rauber, who describes much of what we eat today like this. It's not food, it's an industrially produced edible substance. Companies now engineer products from cheap industrial ingredients, mixed with flavorings, colorings, emulsifiers, and other additives, designed to make food addictive, have an incredibly long-lasting shelf life on top of being extremely cheap to manufacture. Many of these additives have been shown in experiments to damage the gut lining and disrupt the microbiome in animals, causing inflammation, weight gain, cancer, and all other kinds of nasty diseases. Yet a lot of these substances are not even regulated. In the United States alone, thousands of additives are allowed in food, and companies can often self-declare their ingredients safe without independent regulatory review. And the same companies producing these substances also fund large parts of nutrition science and influence public perception about what is actually healthy. So every single day, billions of people are eating products engineered in corporate labs filled with chemical additives whose safety is often evaluated by the very companies selling them. And all of it, every emulsifier, flavor enhancer, and synthetic additive exists for one reason, which is definitely not to nourish people. It's to maximize shareholder value. Reading this book made me especially angry at the actions of giant food corporations, so let me know if you would be interested in watching a video where I share my outrage about the modern food industry with you. But let's move on to another example. The same pressure to maximize shareholder value by aggressive cost cutting has also reshaped industries like aerospace. At Boeing, aggressive cost-cutting and financial pressure have been linked to the catastrophic failures of the 737 MAX aircrafts that killed hundreds of people. Boeing had created a dynamically unstable plane by placing a larger engine in a position that caused the nose to tilt upward. But rather than performing an expensive redesign of the aircraft, the company implemented a software fix known as the MCAS that automatically pushes the nose down, which led to 2 catastrophic airplane crashes, killing hundreds of people. If you want to learn more, I really recommend reading Grace Blakely's book, but there's actually also a great Netflix documentary about it called Downfall: The Case Against Boeing. I could name thousands more examples of how this aggressive cost-cutting culture in the name of increasing shareholder value has cost so many people their lives. But we need to move on, because aggressive cost-cutting wasn't the only way the new asset economy reshaped corporate behavior. Another strategy that became extremely common in the shareholder value era is something called debt loading. Private equity firms often buy companies or essential infrastructure, things like care homes, housing portfolios, or water utilities, so actually really important stuff, and then load those companies up with enormous amounts of debt. The company's own assets and future income are used as collateral, allowing investors to extract money while the business itself becomes increasingly fragile. And if the company eventually collapses under that debt, it's often the workers, residents, or taxpayers who end up bearing the consequences. Another consequence of the asset economy is the replacement of stable jobs with outsourcing. Instead of hiring workers directly, many corporations began subcontracting labor to external firms, temporary agencies, or gig platforms. This allowed companies to cut costs, avoid labour protections, and shift risk onto workers. Stable careers were replaced by short-term contracts. Insecure work and what the economist Guy Standing calls the precariat, a growing class of people living with permanent economic insecurity. Finally, another example is the rise of stock buybacks, where companies use their profits to buy back their own shares instead of investing in workers or innovation. We'll get into the exact mechanics of share buybacks in the next video. So make sure to subscribe if you want to understand how this financial engineering became one of the most powerful tools for boosting shareholder value and what it means for society. But now let's zoom out from all of these single phenomena and let's look at the pattern that starts to emerge. Across industries, from food to aerospace to energy, more and more decisions are shaped not by long-term investment or social need, but by the pressure to maximize asset values. And this financial logic is also one of the reasons the fossil fuel industry continues to dominate, because the system rewards protecting the value of existing assets rather than rapidly transitioning to new energy systems. And once an entire economic system revolves around asset prices, the system stops rewarding production and starts rewarding gambling. And once gambling becomes embedded in the logic of the system, it doesn't stay confined to financial markets. It starts spilling into culture, which brings me back to prediction markets. The prediction market, platforms like Polymarket or Kalshi, that allow people to place bets on the outcome of almost anything. Election, sports games, political speeches, the return of Jesus Christ, and many more weird things. And the absurdest thing isn't the things you are allowed to bet on, it's that these platforms insist that they are not gambling sites. They classify what they're selling as event derivatives. A derivative is a financial product. And they do that for a very simple reason. Financial derivatives are less tightly regulated than gambling. Casinos and other gambling sites have strict rules, age limits, consumer protections, and licensing requirements. So by calling their bets derivative contracts, these platforms can circumvent gambling regulation and operate under financial market rules instead. The fact that financial derivatives are less regulated than gambling is in itself quite telling. Also, it should come as no surprise that Donald Trump Jr. is sitting on the advisory board of Polymarket. But let's get back to gambling. Because if we're being honest, the blurred lines logic that runs between trading and gambling now runs through crypto speculation, AI investment frenzies, and countless other market bubbles. And it makes my original thought feel a lot less absurd. Because maybe our economy feels like a casino because the financial system has quietly turned into one. But I don't want to end this video on such a depressing note. So let's finish with one last question. What can be done about this? As Anne Pettifor wrote, this book is about seeing and paying attention to the international financial and monetary system and its role in accelerating the exploitation of people and the extraction of the Earth's precious finite assets. We must base our comprehension and understanding on this simple reality. The globalized financial system is man-made and designed to be remote and unaccountable. Its design is intentional. And honestly, this is the part that makes me the most angry, because there is another reason why the system has been able to grow so powerful without much public debate. The financial world often hides behind a language of deliberate unintelligibility, the kind of economic gobbledygook that makes ordinary people just switch off. The Wall Street word salad of complicated terms that makes finance sound like some kind of rocket science that ordinary people could never understand. Terms like derivatives, over-the-counter markets, or synthetic securitization make what is often just gambling sound like an advanced scientific discipline. And the effect of that language is simple. If people believe the financial system is too complicated to understand, they are far less likely to question it or demanding that it be redesigned to serve society instead of wealth. I think it's absolutely ridiculous that you have to watch a long YouTube video like this just to understand how the financial system shaping your life actually works. Because why the hell do we learn nothing about the financial system in school when it has such a huge impact on our lives? If more people understood how the system works, we might start asking very different questions about how it should work. And that's exactly what people profiting from the system don't want. So I think if we want to change things, we need to understand the current status quo. And to be honest, that is the aim of my channel, to make financial systems and our economy more understandable. So if you want to learn more, make sure to subscribe, watch my other videos, and if you want to engage deeper, a book club community over on Patreon is absolutely great too, and we have great discussions. Anyway, thank you for watching and see you soon. Bye!